Well, I'm not bearish on gold, and I treat that as a currency. And because I think that this backup in real interest rates, this has been an unprecedented swing in a matter of 2 years. So negative 100 basis points to plus 200, 300 basis points swing in real rates. So I think that real rates will come down. I think the US dollar will come down. That's all you need to know to be bullish on gold, real rates, and the direction of the US dollar. Gold, I still call gold a currency. It's an asset that is no government's liability. I like gold for a whole range of reasons.
David Rosenberg, the founder of Rosenberg Research, holds the view that while a U.S. recession has been delayed, it hasn't been completely derailed. He bases this stance on his belief that deflation in the housing market could trigger panic, a situation he deems favorable for gold. Gold prices edged lower on Friday as the U.S. dollar reclaimed a 2.5-month peak, but the metal was headed for its best week in 6 ahead of a speech by the Federal Reserve Chair for clues on whether rates will go higher or remain at restrictive levels. Rosenberg's optimism toward gold hinges on his anticipation of a decline in real interest rates and a weakening U.S. dollar. Both of these factors would enhance the value of gold in his perspective. However, he acknowledges that this scenario might not be immediate, especially if the Federal Reserve continues to raise interest rates until the unemployment rate experiences a notable uptick. As the annual symposium in Jackson Hole, Wyoming unfolds between August 24th and 26th, the focus turns to Federal Reserve Chair Jerome Powell's speech. Investors are eagerly awaiting clues about the trajectory of interest rates, whether they will remain elevated or ease back. Despite expectations that most Fed speakers will emphasize the need to combat inflation, Rosenberg stands by his belief that interest rates will eventually begin to decrease again. Just before you watch the David Rosenberg's interview and learn more about market trends, consider subscribing to our channel and give this video a big thumbs up. Rosenberg acknowledges the likelihood of a recession but admits uncertainty about its exact onset. While he's unsure about the severity of the economic downturn, he anticipates its duration to be considerable. As Wall Street's prominent recession indicator gains attention, the long-awaited economic decline appears imminent, according to prevailing discussions. If Rosenberg's forecast of a prolonged recession and market turmoil materializes, the demand for gold could experience an upswing.
It's a sort of thing where when gold dips and you play the moving averages, I tend to come in and buy. My last trade was actually to buy, Canadian maple gold coins. They're stored in Ottawa in the vault at the Royal Canadian Mint. Near term Fed more hawkish, driving real rates up. The U.S. dollar has just popped above its 200-day moving average. I think gold's hung in very well in that environment. The near term outlook for gold is one of probably corrects some more, and you want to buy that correction. You see, these are dips I want to buy. I'm not buying dips in the equity market, but I think that fundamentally, and especially in a more troubled world, a more geopolitical world, a world that's going to be, you start thinking of that movie Wag the Dog when you're thinking about Xi Jinping and how he is going to handle social dissent. They're not they decided not to print youth unemployment statistics anymore. Like, are you kidding me? Is that how bad things are in China? And you start thinking about unrest, and then you start drawing lines into Taiwan with a fairly weak president on a global political scale. I mean, there's lots of other reasons. Gold is a hedge against uncertainty. Gold is a natural hedge against turbulent times. And so I think that's what we're heading towards. So I'd say that we can try and get a little cute on the near term. Near term, I'm not as bullish as I am on the long term. That much is true. So near term, the answer to the question is that I could see it dipping further because the U.S. dollar could have more of a counter trend rally here. And I think the Fed is going to continue to bark. The Fed's not going to stop tightening or barking until the unemployment rate starts to go up meaningfully. And that's going to be several months away. That's going to be a challenge for gold near term. But when the rates come down in the U.S., no, I don't think they're going back to QE. I think that game is over. That game was a disaster. But I think the natural course of interest rates are cyclical, and I think we're going to recession. Rates are going to come down. Rates come down. The dollar will come down along those rates. This will be next year's story, and gold's going to go to new highs. That's my forecast. So the recession is going to be coming. It's just a matter of when. No one can time it perfectly. And I don't know if it's going to be a deep recession in terms of peak to trough decline, but I think the duration is going to be very, very frustrating. for the macro bulls. That's my major point. The longer you have stagnant demand, you're not going to have much in the way of inflation. Unless the supply curve is backward sloping, you're going to be having years of disinflation. And that's not in the market. Everybody's got inflation on the brain because everybody's been trained to think about inflation because they're still thinking about the summer of 2022. They haven't gone past the fact that inflation has already collapsed. And we haven't even seen the impact of rents hit the CPI. Rents are 30% of the index. The San Fran Fed just did a report showing that by this time next year, the year-over-year growth in rents, and rents are 30% of the CPI, is going to be zero. So depending on what the other 70% of the CPI does, don't you see, we're going to be lopping off 2.5 percentage points off the headline inflation rate at a time when it's 3%. So I'll posit to you that by this time next year, the CPI is probably not going to be negative, but it's going to be between 0 and 1%.
Rosenberg underscores the significant influence that China's economic performance wields on the global stage. He contends that if China's economy slips into a recession, it could trigger a decline in global demand for goods. This possibility arises from the fact that China has long been the driving force behind global growth. However, recent indicators have raised concerns as China's economic momentum has waned, causing alarm among international leaders and investors. Capital Economics, a London-based research firm, has estimated that China's trend growth rate has decelerated from 5% in 2019 to approximately 3%, and it is projected to further decline to around 2% by 2030. Moreover, Rosenberg addresses the Fed's approach to managing inflation. When inflation becomes pronounced, as has been the case in recent years, the Fed's response typically involves raising interest rates, sometimes aggressively, to temper economic growth and counteract rising prices. This strategy, though aimed at curbing inflation, can have broader economic consequences such as rendering mortgages, auto loans, credit card borrowing, and business lending more costly. As we approach the fourth quarter of 2023, the specter of a global recession remains a concern. The August Sales Managers Survey data underscores this uncertainty, particularly as both the USA and China exhibit signs of fragility in the face of mounting interest rate pressures. Let's get back to the interview.
So you can't forecast inflation or prices without two curves. You need supply, you need demand. And what happened is that we had tremendous fiscal stimulus that gave us a sugar high that brought demand over supply and gave us the inflation that we had when inflation rate hit 9% in the summer of 2022. And we had the big spike. We had the big spike in oil. Oil's now 80 for WTI. It was 120. All the commodities pretty well are below their previous peaks. But we had a nice run up in commodity inflation because governments went way overboard, dramatically stimulated. Of course, central banks underwrote the fiscal expansion through monetary policy. So yeah, right. For a period of 18 months, we had the big inflation. It's in the rearview mirror. And so the question is, what is demand? You brought it up. What is demand going to look like? What is demand going to look like as China goes into a recession? China consumes half the world's basic materials. China's going into recession. And that's going to have all sorts of knock-on effects. There's no such thing as decoupling. China goes into recession and everybody's whistling Dixie in all parts of the world. It's just a made in China event. Sure. That's what they were saying at Merrill. Back when I was there, pounding the fist on the table in 2006 and 2007, global decoupling. The U.S. goes into recession. The rest of the world will be okay. Sure, that call turned out to be really good. So we are still globally intertwined. You can argue about at the margin deglobalization, but it's partial. We're still more globally intertwined in terms of trade channels and investment channels than ever before. And China going into recession is going to be a major global, if you don't like the word deflation, call it disinflationary event. It's going to have a monumental impact on global demand. So we can talk about the inelastic supply curve for all the different components that go into the CRB index, and I agree with that. But you can't forecast prices with one curve. You can't just say, well, here's the supply curve. Where's the demand curve going? And then we haven't seen the full impact of what the Fed has done on demand in the United States. The Fed starts tightening policy in the summer of 2004. The recession started in 2007. The Fed started tightening policy in 1999. The recession started 2001. There's just people out there that say, well, if the recession doesn't start immediately after the Fed starts raising rates, it's never going to happen. but history doesn't bear that out. So we're going to have a global recession, and I don't know how long it's going to last. But because central banks are so freaked out over inflation, they're going to be very slow to react to help out the economy. The economy's not going to get a get-out-of-jail-free card this time around. They're not getting a community chest card in the game of Monopoly. That's not happening. And you're talking about fiscal policy. Well, all the fiscal stimulus from Joe Biden was when he had the House and the Senate under Democratic rule. We have an election next year. Chances that we get a split government is going to be high once again. And once you get a split government, you don't typically get much in the way of fiscal stimulus. You get the fiscal stimulus like you did, for example, in the first couple of years of the Clinton administration, fiscal stimulus, and that's it. Then you get the first couple of years of Barack Obama. You get stimulus. That's it. 2 years out of 8 years, you get fiscal stimulus, and then the Republicans take over, or the House and the Senate are split, and all the president can do is executive order. But that's not fiscal stimulus. All the stimulus by Joe Biden was all done in his first 2 years when he had the House and the Senate. Those days are over. There is no fiscal stimulus coming to the United States going forward. It's yesterday's story. And the Fed's going to be the Fed that was so humbled and embarrassed by missing transitory, they're not going to be easing policy that quickly. They'll be too late to save the economy. And remember that the lags work both ways. And so when they cut rates, we'll have the next economic cycle to the upside, but the Fed's going to take its time. That's a big problem.
The risk of a U.S. recession is increasing as the Federal Reserve raises interest rates in an effort to combat inflation. What is your outlook for the gold market in the next few years? Do you think the U.S. recession is inevitable? Let us know in the comment section. If you liked the video, don't forget to subscribe to our channel and tap the bell icon so you don't miss out on our upcoming content. Surprisingly, around 89% of our viewers haven't subscribed yet. We're aiming to reach 3,000 subscribers in the next 2 weeks, and your support could make a big difference. Thank you for being a part of our community.